Hey there, my name is Pouchain, and I would like to give you a gift today. The good thing about this gift is that if you use it well, it can become anything that you want. From a blank check to a trip to Paris. I mean, I don't know about you, but I love Paris and fast cars. Who doesn't like Paris? The only problem with those two desires is that they cost money, so we must save money in order to obtain them. When most people think about saving money, the first thought that pops into their head is opening a savings account. Unfortunately, for most people, opening a savings account is as profitable as stuffing money under your mattress. That trip to Paris will have to wait because in both cases you're losing your hard earned dollars. But wait, whenever I say that you're losing money, I don't mean that your bank is stealing from you or your bedbugs are eating your money. To clarify, you're losing buying power. How, you may ask? Simple. The inflation rate is greater than the average rate of interest in a savings account. The average interest rate in a savings account is around 0.06%, and it can get even to 0.01% in bigger banks, while inflation is at 2%. Thus, it means that inflation is murdering your buying power. What's inflation? Simple, rising prices. Let me give you an example. 40 years ago, the average price of a car was around $3,000, and the average gallon of gas was 33 cents. Well, today, the average price of a car is around $33,000, and I don't need to tell you the average price of gas. Most people do not take advantage of the opportunities regarding capital markets and investments. In fact, according to the Federal Reserve Bank, millions of Americans are struggling financially, living from paycheck to paycheck, relying on credit card for the most basic necessities, only to wind up high in debt and low on hope. Kids aren't taught any of this in high school because while they can speak 5 languages inside the entire periodic table, they still think that a CD is something that has music on it and a bond is a merely chemical connection. Okay, so back to your gift. What exactly do you have to do in order to cash that check or claim your gift? Simple. Walk into an investment bank. Well, you may say, that doesn't sound simple. I promise that will be easier than changing your cell phone carrier. So, why you want to make money at a small rate if you can make money at a bigger rate with the same amount of work? You don't need to be using boat in order to run. You don't need to be Steve Jobs in order to use a computer. So you don't need to be Warren Buffett in order to invest. In the investment bank, you're going to give yourself one of the greatest gifts of your life, an investment manager. An investment manager is an educated professional or institution that helps their clients meet long-term financial goals. To be specific, a portfolio manager, PM, will directly invest your capital in a variety of assets in order to meet your expectations and your financial goals. All the hard work is on him. He will build a portfolio, monitor on a daily basis, rebalance it, buy, sell, and analyze various securities. Not convinced yet? Let me give you an example. There's Jeff and Felicia. Jeff and Felicia receive the same salary and both of them save the same amount of money, $1,000 a month. Felicia deposits $1,000 a month deposits $1,000 a month into her savings account every month, while Jeff deposits $1,000 a month in his PM account. In 20 years, Felicia will have around $300,000, while Jeff will have $980,000. So, okay, you're in the investment bank. Once you're there, you need some of the financial information that you used to finance your house, for example, or buy your car. But you also need to say some more specific financial terms in order to your manager be able to attain your goals. So let's review some of them. First, your financial goal. Second, your coefficient of risk aversion. And third, your investment length or horizon. Okay, your financial goal. Your financial goal must be as concrete as possible. It cannot be vague. For example, with a vague with a vague goal, your manager will not be able to build a portfolio that can meet your expectations. One example, I wanted to retire at 60, travel 3 times a year to Paris while paying my bills and leaving some assets for my kids. Second, your coefficient of risk aversion. Your coefficient of risk aversion determines how much or little risk you are willing to take. And it varies from 2 to 4, with 4 being extremely risk averse. And last but not least, your investment length or horizon. Your investment length or horizon is basically the amount of time that you want that return or the investment back. Investment horizon stands for the total amount of time that you plan to hold the portfolio. So that will inform the manager to build a portfolio that will give your return in the time that you expect. Well, after all of this that I told you, are you convinced yet? If so, see you in Paris. Thank you.